I'm Fillmore, president and founder of Trac Financial. Today we're going to be covering the tax law changes that have been proposed and specifically to discuss what the changes are, why they're important, where this is leading into the future, what today's taxes are like compared to the taxes we'll pay in the future and what past tax rates are, as well as what are some things that you should be doing to try to mitigate taxes into the future. So here are the changes that have been proposed. First off, they're going to potentially increase taxes for the highest of income earners. So anyone earning over $450,000 as a married couple or $400,000 as a single individual will have their marginal tax rate raised from 37 up to 39.6%. Now, in addition to this, also income earners that earn over $5 million will have another excess tax of 3% on any income over that figure. So effectively, the highest tax rate is now over 40%, but politicians can still say it's not using this excise rule. The other thing that we're looking at are capital gains taxes going up. Again, for those that are over 450 or 400 as single. Currently, the tax rate for this group would be 20%, and that's being increased up to 25%. So this had been proposed to match the tax rates of the income tax, so 20 going up to 39.6. That has since been revised down to 25%. Many of these laws have changed during the proposal process, and we still don't have these laws in place yet. There still is a chance that they could not be passed. But at this stage, they've lowered this down to 25%. One thing that's unique, though, about this is they're actually making this tax change retroactive back to September 13th, 2021. Something that doesn't happen often, and I'm not so sure the politicians considered all the changes that the IRS will have to make this happen. It's actually a lot of work for the IRS to start to figure out, well, what was before and after September 13th, a lot of paperwork involved and changing forms and things of that nature. So this is something that could fall by the wayside by the end of the year and may become something that becomes effective as of January 1st. But we can't hold our breath. The government is trying to gather up as much money as they can so they can spend it for us. Anyway, estate taxes is the next category that we'll be discussing. Estate taxes will be cut in half. Basically, the estate tax exemptions previously were increased up to $11.7 million per individual. So you have over $22 million, $23 million for a married couple. This is going to be reduced in half, back down to levels that were closer a few years back. So each person will now have about $5.85 million as an exemption. Give a married couple, again, about that $11.7 million as a total household exemption from estate taxes. Now, these numbers are all high in terms of net worth for a lot of people, but remember, these numbers change frequently. There was a time when these were $1 million, not that long ago, and then they were raised to 5 and then up to 11 and a half. Adjusted for inflation, it's continued to rise. So these tax law changes that are going into place have actually been discussed to be even lower than the five something million that they're at today, what they're trying to implement them at. It's been proposed that it could be $3.5 million. So for them to reduce the estate tax back from 11.5 down to 5.85, that's going to affect a lot more people, a lot more families, a lot more households, and a lot of businesses, which is really one of the major issues with this, is families having to pay the estate taxes when a business is inherited. Farms also are dramatically affected by this, where farm land has a lot of value according to the IRS, and the estate tax is 40% on anything over that estate tax exemption. So this can be a major, major tax for people if you're not prepared. Now, if they again reduce this down from the 5.85 million to the proposed 3.5 million that's been proposed by some legislators, that's going to hit a much larger population group. And more people will need to be looking at strategies to try to prevent these massive estate taxes. 40% for the estate tax, plus if you have IRA assets, retirement accounts, those are also going to be taxed at an income tax rate, which could, in effect, have a 30-something% rate on top of the 40%. Your beneficiaries could pay over 70% on your assets when you pass. So, you know, the ILIT, the Irrevocable Life Insurance Trust, is going to be something that's going to be really appropriate for someone at this asset level. Next, we have corporate tax rates. So this is proposed to increase from 21% up to 26.5%. Most likely, the 26.5 will not be the final number that's approved. Joe Manchin out of West Virginia, the Democrat, has a lot of clout right now because he's in the middle and he's kind of deciding whether he wants to approve things or not. And he's said that 26.5 is not a number he wants to see. So this likely will get pared down and revised down to 25% is the likely number there. Now, retirement account changes. This is really the big thing that's going to affect pretty much everyone here in the country, because changing the way that they tax retirement accounts has gigantic ramifications over the long run. What they're talking about doing is shifting the thinking in how retirement accounts will be taxed now and into the future. So this is pretty dramatic how they're changing this thinking, and they're effectively going to penalize good savers. They're going to say to you, hey, you know what? You now have too much saved in retirement accounts, so we're now going to tax those retirement accounts at a higher level. This is something they've never done before, and it is a dramatic change. So we really need to look at strategies to figure out how to avoid these potential tax changes. Now, again, this affects the married couples over $450,000 or $400,000. Roth conversions, they're talking about disallowing these after December 31st, 2031. Now, that gives us a 10-year runway before they change these tax laws. That is, as long as this is in fact meant to be 2031. Some people have suggested that maybe this was a typo, that it should have been 2021. But I think it's actually correct. They're giving you a 10-year opportunity to make Roth conversions, and after that, you won't be able to do them, okay? Now, again, right now, this is affecting the higher income earners, but it wouldn't surprise me to see this trickle down over time to affect more people at lower income levels. The government's realizing that Roths are too good of a deal, so they're trying to take them away from basically anyone they can, but they're starting at the top first. Now, that was for $450,000, $400,000 and above. This retirement account change affects anyone of any income tax level. And that is, Roth conversions of after-tax money will no longer be allowed at all. Okay, so if you've done a deductible IRA in the past, a non-deductible IRA in the past, that will no longer be able to be converted over to a Roth. So you can see here, they're starting to take away the Roth option. The other thing is, the old strategy of the backdoor Roth will no longer be allowed either for anyone, starting after December 31st, 2021. So these are major changes in Roths. I expect more this to continue more and to see these types of laws passed continuing moving forward. Now, here's another major change, is that large account balance IRAs and retirement accounts are going to be taxed at a higher level because they're going to force extra withdrawals on you if you have larger accounts. So the first level that will be affected is anyone who has $10 million and above in retirement accounts. Okay? If you have over $10 million, any excess over that $10 million, you will have to take a required minimum distribution of 50% of the excess. So what that means is if you have a $12 million in retirement accounts, that's $2 million in excess. You'll have to take out 50% of that, or $1 million all at once, and be taxed on that all at once. A very significant tax bill, obviously, on a $1 million withdrawal. Now, the other thing is there's another level even higher for those with over 20 million in retirement accounts. In this case, you have 100% required minimum distribution on the excess. So if you have over $20 million, you have to bring that number right back down to 20. No exceptions here. So this again is affecting high numbers. They're also disallowing people in these categories to even contribute to any types of retirement accounts in the future as well, because they consider them to have too much in retirement accounts, too many tax advantages. So people have been asking, will this law pass? You know, we never know what'll happen in Washington with the politics, but I do think that this is going to pass. And the reason why I think this is there's a couple reasons. For one thing, a lot of these figures have already been pared down from what was originally proposed. So since they've already done a lot of the negotiation, it's really just about getting across the finish line here in the last months of 2021. The other thing is politicians are always thinking about being politicians. So this is a non-election year. So this is the type of time that politicians will go ahead and pass legislation like this that's not as popular, because no one likes to see their income taxes or any taxes increased on them. So it's not all that popular. You're not really buying votes when you agree to raise taxes. You can do it the other way, but you can't buy them when you raise taxes. So I do think this will pass. Now, why is this important for everyone to know about? Sure, you might be thinking this might not affect you, but all of this affects all of us. And the reason is because the reason they're passing this bill is to generate income that's lost from all the spending bills that they've passed. So the major question here is, how much revenue is this bill going to generate? So this is a revenue generating bill, and it is estimated to generate over the next 10 years $2.9 trillion for the federal government. Okay? Now the purpose of this bill is really to offset the potential bills that they're going to pass here coming up very soon, or planning to pass. So the first one is the American Jobs Plan Act. It's $2.3 trillion bill to the taxpayers essentially over time. Well, right now it's just an addition to our lovely deficit. So that's $2.3 trillion. Now it's been said that number is probably too high. It'll probably get trimmed down to only $1.2 trillion. It's funny how we can talk about $1 trillion only being $1 trillion now these days, after what we've seen with some of the other laws and stimulus packages that have been passed. But that's the first bill that is likely to be up for vote here soon. The second bill is the infrastructure bill, the American Families Plan. This one's estimated at a $3.5 trillion tax bill. Okay, so the main reason for implementing these tax changes and increasing taxes is to pay for the infrastructure bill. Now listen to the numbers. The infrastructure bill is $3.5 billion. The tax bill generates $2.9 billion. So does the bill even cover that one piece of legislation? No, it obviously does not. And how short are they? Well, 3.5 to 2.9 trillion, you're $6 billion or $600 billion short there as well. So, when I look at this, I think you've got a couple bills here that could be passed that are likely to be in excess of $4 trillion. You're really only scratching the surface and only generating enough to cover, more than half of it, but not much more than that, let alone all the other stimulus packages that they've had to sign after coronavirus and put those in place. So what does this all mean? Well, it all means that this thing here, our deficit, is going to keep on ballooning. And if you've ever been to usdebtclock.org, you can actually see our debt increasing every second. Now it's close to 29 trillion currently. This is before passing any of the any of the stimulus packages like the infrastructure bill and these two plans we just talked about, the American Jobs Plan and the American Family Plan. So what does this all really mean? Well, to me it means taxes are going to have to go up. So there was a man who was actually his role was he was the head of the accounting office for the government. So he's basically the government CPA. And he actually asked a question on a radio station once, and he said, there's a 4-letter word for why taxes will go up in the future. And he asked people to try to guess what the 4-letter word was. Well, you know what the punchline was? The reason why taxes will increase in the future is simply math. Math is the 4-letter word, okay? So right now, they're hitting the highest income earners, but will that stay at that same level? I don't believe it will. I think it's ultimately the tax brackets are going to come down and hit more of the average income earners. If you look here at our chart, this is actually a history of taxes over time in this country. And what you'll see is in this range of this period of time here, there was over 50 years where the tax rate was 50% or higher, the highest tax bracket. Most of that time it was actually 60% or higher for the highest tax bracket. Right now, we're at 37%, potentially going up to 39.6, okay? Now, think about that. That's actually a low number compared to historically what the highest tax brackets have been. So, do we have low taxes now? I believe absolutely. So, knowing this, a lot of people say to me, well, Kurt, I'm not in the highest tax bracket, and I don't think I will get to the highest tax bracket. But we have to look at the history of the tax brackets in the past to really understand if this will really impact you later on. So let's look at taxes in 1980. So if you looked at the tax rates in 1980 and inflation-adjusted income back to that period, someone earning $200,000 today would be earning about $60,000 back in 1980, okay? So a married couple earning $200,000 today. Can you guess what tax rate they were in, what tax bracket they were in 1980 if they were earning $200,000 inflation adjusted? That number, 54%. Okay, today you're in a 24% tax bracket at $200,000 in income for a married couple. So 24 compared to 54. Do you think that your tax rates can go up into the future based on where they are today? Absolutely. If that married couple had a nice year, they earned some extra income for whatever reason, and they went up to more like $250,000, a little bit above. Again, inflation adjusted that to 1980, that's now a 59% tax bracket. For someone who's earning, a couple who's earning a nice living, but it's not a living that is the highest tax bracket. So it's really something to understand that I do think across the board, the taxes will eventually be going up, simply because there's no way for the government to pay back all this debt that they've accrued and that they continue to accrue over time. So what can we do about this? What kind of strategies can we look at? One thing is strategically integrating Roth IRAs into our retirement plan. Right now, most people have their money all in pre-tax dollars, and those pre-tax dollars are likely to be taxed at higher and higher rates as we go along over time. So moving these into Roth IRAs can be a huge benefit with your taxes over the long run. The other thing about this too, that a lot of people don't realize is many people have too much money in pre-tax accounts. They're not really diversified when it comes to their taxes. On average, 91% of people have 91% of their money in retirement accounts. Very large percentage. I should say in pre-tax retirement accounts. So we want to start moving that into some after-tax and some pre-tax accounts. we want to start moving that into some after-tax and some tax-free accounts, such as the Roth IRA. Some other things you can do here, tax harvesting of your capital gains. You also want to be looking at things like QCDs. If you're giving charitable contributions, your RMDs can be used to provide to charity. DAFs, CRTs. As I mentioned earlier, for estate taxes, we have ILETs, irrevocable life insurance accounts that we can be looking at. So there's a lot of different strategies here that we can look at long-term that'll apply for some people, some of them won't. But this is something you really want to look at and make sure you're addressing all the potential consequences of the new tax law and all the potential ways to start lowering that tax bill long-term. So, Ralph Waldo Emerson said at one point, he said, "Do not go where the path may lead. Go instead where there is no path and leave a trail." So what I encourage you to do is don't follow the herd. Don't just let these tax law changes follow you in the path that everyone else is going on. Follow a new path. Make sure that you're learning about these tax changes and how you can learn some strategies to actually avoid a lot of this. Create a new path for yourself that'll help you to live a more comfortable retirement and, in fact, pass on more money to you and your family into the future. So if you have further questions about this topic, feel free to give us a call or comment on our video. We'd be happy to speak with you about what strategies might help you in particular. So give our office a call. I'd be happy to talk to you or one of our advisors, and we'll let you know when we have the next video. Have a good one.